Okay, let's unpack this. We are diving deep into PUMA today, one of the biggest names in sportswear, obviously, and we're looking at a really dramatic but apparently intentional financial move they made back in Q3 2025. This wasn't some market crash hitting them. This was, well, the company itself deliberately slamming on the brakes, taking a huge financial loss in what they actually called their year of reset.
Yeah, that takes some serious strategic conviction, doesn't it? Especially with everyone watching.
Yeah.
So our mission here today is really to dig into the official excerpts from their Q3 and 9-month 2025 earnings report. We want to get at the core strategic thinking. Why on earth would a global brand like PMA willingly take a hit worth hundreds of millions of euros?
Well, the answer seems to come straight from the CEO, Arthur Holt. The big problem PUMA was tackling was, and this is their term, the brand had become too commercial. That phrase, too commercial, I mean, that sounds like a pretty blunt admission, doesn't it? Maybe a strategic misstep.
It really is. It strongly suggests they'd been chasing, easy volume sales,
Right.
maybe sacrificing brand integrity, long-term value. PMA pointed to three main internal issues driving this aggressive surgery. First, their brand momentum felt a bit muted. Second, inventory levels were just too high everywhere, across the trade. And maybe most critically, the quality of their distribution was low.
Low quality of distribution. So basically selling their stuff anywhere and everywhere, kind of watering down the brand.
Exactly that.
Yeah.
They realized if they wanted to hit their big goal, becoming a top 3 global sports brand, they absolutely had to reverse that trend, no matter the immediate financial pain. And this isn't a quick fix, They've laid out a pretty clear timeline for this whole thing.
They have. It's a multi-year plan, which is really important for you to grasp when we look at these stark Q3 numbers. So 2025 is the reset year. That's the pain, the big correction. Then 2026 is planned as a transition year, sort of stabilizing things on this new, hopefully higher quality foundation. And then the return to actual growth, profitable growth, that's only targeted for 2027 onwards.
So yeah, we really need to look at these Q3 results not as some kind of failure, but more like an expensive down payment on their future brand image, their prestige.
Right. Let's look at that down payment then. Section 1, the immediate financial pain. If you need proof this reset actually happened, just look at the sales numbers. QMA sales dropped by 10.4% currency adjusted. That came out to about 1,955.7 million. And on a reported basis, it's even starker, a 15.3% fall.
And the report really hammers this home.
Yeah.
This huge drop was overwhelmingly because of these strategic reset actions. They deliberately cut off that high-volume, low-margin business.
Yeah.
But the really telling part is looking at the costs tied to this cleanup.
Which hit the gross profit margin straight away.
Oh, yeah. It plunged down 260 basis points, landing at 45.2%. I mean, a drop like that is pretty substantial. It really shows the pressure PMA put on itself. The reasons were varied.
Yeah.
More wholesale promotions to shift unwanted stock fast,
Yeah.
higher freight costs, and this is key, they booked really significant inventory reserves because of this distribution cleanup.
Let's just pause on inventory reserves for a second. When a company does that, books a reserve, what are they signaling about that specific stock?
Well, they're essentially telling the market, we've got inventory here that we don't think we can sell at its full price, or maybe even sell at all, within a decent time frame, given the new strategy. So they have to set aside that amount on their books to account for the likely deep discounts, or maybe the stuff just becoming obsolete. It's a direct admission that some past product choices or distribution channels were basically flawed.
Okay. And when you add up all those hits to the margin, the pain flows right down to that bottom line profit metric we watch, EBIT.
The EBIT figures are just staggering, and precisely because this loss was kind of engineered, right? Reported earnings before interest and taxes went from a pretty healthy $237 million in Q3 2024 down to just $29.4 million in Q3 2025. That's roughly a 90% collapse in quarterly operating profit.
90%. Wow. That really shows the scale of the hit they chose to take.
Which naturally is why the bottom line went negative. PUMA reported a net loss for that quarter of $62.3 million. And if you look at the year-to-date picture, the first 9 months of 2025, the net loss balloons to a pretty eye-watering $308.9 million. That huge sacrifice, over 300 million euros gone, that is the explicit cost of trying to fix a brand that got too commercial.
Okay, so now we get the cost. Let's talk about how they actually spent that money. The core problem, distribution quality, it's centered on wholesale, right? What exactly did PUMA do to stop being too commercial?
They went after wholesale very deliberately. The wholesale business itself dropped 15.4%, currency adjusted, And this came from two main actions. One, they started doing significant takebacks, basically pulling excess inventory out of retailers' hands. And two, they acted immediately to cut their exposure to what they called undesirable business.
And the main target for undesirable business was mass merchants. You should probably explain why these retailers are such a strategic headache.
Right. So POMA defines mass merchants as those really big, high-volume retailers. Think huge national chains. They tend to sell products mainly at big discounts, sometimes using POMA gear just to get people in the door. But crucially, these places give the brand very little control over how the product is priced, displayed, or presented overall. And when a premium brand keeps showing up on clearance racks next to, less premium stuff, it really damages the brand's aspirational quality, its prestige.
So PMA effectively said, look, we'd rather lose millions in immediate sales than let our brand be defined by discount bins and messy distribution.
Absolutely. And that decision hit North America hardest, particularly the U.S. market,
Right.
because that region apparently had a much higher dependence on these mass merchants in its wholesale mix.
Yeah.
So exiting that business caused the most pain right there.
Now, this brings us to that paradox you mentioned. If PMA is taking back mountains of excess stock from wholesalers, what does that do to PMA's own books? Their inventory must have shot up, right?
That's the really interesting twist here. You're cleaning up the market, but your own inventory levels actually jumped. Up 17.3%, reported to 2,124.1 million by the end of September 2025. And yeah, that increase is largely because of those wholesale takebacks. PMA basically bought the problem inventory back from the market so they could control how it gets dealt with.
Huh. So they didn't just make the problem go away for the wholesaler, they kind of shifted it onto their own balance sheet.
Exactly right. They took on the risk themselves. The plan now is to get that high inventory level back to normal by the end of 2026, which will mean some pretty aggressive clearance activity using their own factory outlets and also carefully selected wholesale partners,
Yeah.
partners who will play by PMA's new rules.
Okay, so while wholesale was getting hammered, was there any positive signal? Anything pointing towards the new strategy working? DTC, direct to consumer, that must be the key, right?
That really is the silver lining, the signpost to the future. Because even with all this financial turmoil around it, the DTC business actually grew, a healthy 4.5% currency adjusted, reaching $570 million, which means the DTC share of PMA's total sales jumped pretty significantly. It went from 25.1% in Q3 2024 up to 29.1% in Q3 2025. That 4 percentage point leap is quite telling.
That does signal the pivot is working, doesn't it? Or at least that consumers are responding well in the channels where PMA has total control. Control over price, presentation, the whole experience.
And that control is exactly what high-quality distribution is all about. Regionally, though, we have to acknowledge the price paid. The Americas region saw the biggest sales cut down 15.2%, almost entirely driven by pulling out of that U.S. mass merchant business so quickly.
Okay, so that was the big expensive cleanup. Let's pivot now to the future, the strategic roadmap. How are they planning to actually achieve this ambitious top 3 goal? What structural changes are happening inside the company beyond just moving inventory around?
This is where you see the really aggressive drive for cost efficiency. They're not just cutting undesirable sales, they're cutting headcount too, presumably to reinvest those savings. PMA announced they're expanding their cost efficiency program. They're targeting a reduction of another 900 or so white-collar jobs globally. That's by the end of 2026.
900. On top of the 500 roles they already cut earlier in 2025 under that next level initiative, wow, that's 1,400 roles gone in about 2 years. That's a serious commitment to becoming leaner.
It definitely reflects a realization that the old structure was maybe built for that high-volume, too-commercial model that they're now ditching. They're also simplifying the product lineup, cutting down the number of new styles, new articles introduced each season. Fewer SKUs means lower production costs, less inventory risk down the line, and, well, a clearer message for the consumer, hopefully.
And they've shuffled management significantly, too, to kind of underline this new focus on brand clarity.
Absolutely crucial. Ria Valdez was named Chief Brand Officer. That puts brand marketing, product, creative direction, innovation, and go-to-market all under one leader. That kind of unification is really key if you want consistent storytelling and product execution worldwide. Plus, they brought in Andreas Hubert as the new COO back in July, presumably to make sure the operations run smoothly during all this disruption.
They're even looking at smaller but maybe complex operational bits, like that PUMA United partnership.
Yeah, that's the one that handles their socks and body wear in the U.S. and Canada. They're thinking about shifting it from the current partnership setup to more of a licensing deal, which basically simplifies things for PUMA internally, cuts down operational hassle, and lets them focus their own people and money purely on those core, high-credibility sports areas.
Okay, let's dive into that brand strategy then. If the new mantra is performance first, where are they putting their resources? What are the focus areas?
They're narrowing the focus for growth efforts onto four distinct pillars where they feel they have high credibility.
Hmm.
Those are football, running, training, and then the more curated sports style select and prime categories. The idea is to really lean into their 77 years of history, dig into those rich archives to build authenticity.
And their position in major global sports is a massive asset here, surely.
It's foundational. The source material really stresses that PUNA is one of only 4 brands globally that has real credibility across a wide range of major sports. We're talking top-tier partnerships with huge visibility. Manchester City, the Portugal national football team, and critically, being the official match ball supplier for like the 3 most watched football leagues in Europe, the Premier League, La Liga, and Serie A. That kind of consistent, high-level sports presence is really the antidote to being seen as too commercial.
But here's the interesting part, isn't it? Even while they were doing all this painful cleanup work, some product lines actually managed to grow. What were those specific bright spots, the things that show the brand still has some underlying juice?
Yeah, the performance categories definitely showed resilience. Basketball, which is huge for culture, saw healthy growth. That was helped by launching the new HALI 1 shoe successfully. Performance running launched the Velocity Nitro 4. And in that sports style prime segment, heritage stuff like the Speedcat shoe family is apparently doing extremely well in APAC. So that pull from the archives is working, at least in some key markets.
And training is hot too, right? Thanks to that HYROC partnership.
It's exactly. PME is the exclusive partner for what's basically the fastest growing fitness race series in the world right now. That gives them real, authentic credibility in the training space. It moves them away from just generic gym wear towards purpose-built, high-performance gear. The overall aim seems simple enough: become more focused on the consumer by establishing real product icons, like the PMA Suede. Things people can connect with that stand for something specific and authentic, making sure every product has roots in genuine sport. So if we kind of zoom out and synthesize this whole story, PMA is taking massive, painful, but very decisive control of its destiny here. They are consciously choosing to endure these big Q3 losses, absorbing over $300 million in financial pain across 9 months. Plus, making significant job cuts, all to surgically fix fundamental issues with their distribution quality. Sacrificing that short-term volume, mainly by walking away from mass merchants, that's the investment they believe is needed for high-quality, brand-led growth, which they're targeting for 2027.
Yeah, we've traced the damage from the cleanup, the precision of the cuts, both in costs and distribution, and that refocus on heritage and performance credibility. It really wasn't just a bad quarter. It was, as you said, a deeply calculated, intentional bet on their future reputation, all banking on reaching that coveted top 3 spot in the global sports market.
Which brings us to a really important question for you listening to this.
Hmm.
We've seen the staggering cost, $308.9 million in net income, just vanished in 9 months, all to fix a brand image that had become too commercial. What really stands out is just the sheer scale of investment it takes to turn a ship like this around in the retail world. So the critical question, both for PMA and for you to think about, is this: will their commitment to cutting ties with mass merchants, sacrificing all that immediate volume, will it actually pay off in terms of brand prestige and sustainable high-margin profit before that target growth year of 2027 arrives?